Hello everybody and welcome to this Sustainalytics webinar on our new 10 for 2017 report entitled Investment Themes in a Changing World. My name is Hendrik Garntz and I'm heading Sustainalytics global thematic and sector research teams, and I'm welcoming you to today's webinar in my role as your moderator for this session. So over 400 people have registered for this webinar, and we are certainly delighted that so many of you can join us today. For those of you who are unfamiliar with who we are and what we do, Sustainalytics is a responsible investment research firm providing detailed ratings and analyses on company, environmental, social and governance performance for institutional investors to integrate in their investment decision-making processes. Sustainalytics ranked number 2 as best firm for SRI research in the 2016 ERI survey published just a few days ago. One of the many things that Sustainalytics does is to produce top-down research including sector reports, smaller and larger thematic notes, and periodical pieces such as our 10-4 series. The reports we are publishing under this banner have in common that they take a look at 10 company stories for the year that we consider interesting from an ESG investment perspective. For this year, we decided to present a broadly diversified portfolio of investment themes to you, following last year's focus on climate change and the Paris Agreement. We are also taking a look back at our 10 for 2016 ideas against the background of their share price performance. I'm joined today by my colleague Doug Morrow, who is leading our thematic research team and will present the key findings and takeaways of the report to you in a moment. Before we begin, I would like to highlight some housekeeping issues for you. This presentation will take approximately 60 minutes and will be interjected and concluded by Q&A sessions. You're currently all muted and will remain so for the duration of the webinar in order to minimize any noise disturbance. In this instance, we invite you to send any questions you have about the report or webinar to us through the interactive box you see at the bottom of the screen, here highlighted with the number 1. Incidentally, if you have any audio problems during the course of the webinar, you can also inform us of these through this interactive box. Also, if you would like to minimize this interactive panel, you can quite simply do so by clicking on the arrow at the top of the panel indicated by the number 2. Finally, this webinar is being recorded and a copy of this recording will be sent to all participants in coming days. With this, I'm going to hand over to Doug now, who will present the main findings of the report to you now. So Doug, over to you.
Thank you very much, Hendrik, and welcome again to everyone on today's webinar. Thank you very kindly indeed for joining. As Hendrik mentioned, I'm the Associate Director of our thematic research team, and I sit here in our Toronto office, and I'm really pleased to be here today to share some of the key findings from our recent thematic report, 10 for 2017, Investment Themes in a Changing World. And as you can see on the slide, I thought I'd begin by quickly introducing the report and briefly describing how we put it together, and then I'll give a 2 to 3 minute summary of each of the investment themes that we talk about in the report, and I'll go over some of the opportunities that we see developing in the market over the next 12 months and beyond. I'll then conclude, as Hendrik mentioned, by revisiting the 10 companies that we profiled at about this time last year in our 10 for 2016 report, which focused on climate change to reflect what was then the recent adoption of the Paris Agreement at COP21. And as always, we're hoping for a lively Q&A, so I will aim to keep my talk as succinct as possible, recognizing there is quite a bit of ground to cover, but I'll aim to do it as concisely as I can. So I think the first thing to stress about our 10 for 2017 report is that it really drills down at a tactical level to investment ideas that we think are fundamentally attractive, just given some of the broad trends that are taking place across the economy. And what we did is, with the report, for those of you who have read it, we sought to describe the drivers of each of these themes and then summarize the nature of the opportunity, but then also identify companies that have upside exposure or are otherwise well positioned on the themes and issues that we're talking about. Now, I stress that our company level analysis does not include financial or price analysis. It's driven by companies' performance in our ESG ratings model, and in particular on specific indicators as appropriate and as we'll see. But nevertheless, I think many of the themes that we describe in the report have broad appeal, and I think will resonate with investors that are not necessarily focused on ESG, as well as those that are. So as you can see on the slide here, the themes are really quite wide-ranging. They include a mixture of technologies, markets for specific sustainable products and services, and the effect of certain types of regulation in certain markets. And essentially we came to land on these 10 themes through a mixture of art and science, as I like to say. For instance, on the one hand, we looked at important trends, market forecasts, in some cases specific catalysts taking place in 2017, but we also hedged a bit to make sure that we had some diversity across E, S, and G. So what I thought I'd do now is, as I said earlier, present maybe a 2 to 3 minute summary of each of the themes that we looked at. I won't necessarily get into all the details in the interest of time, but I'd be happy to answer any detailed questions to the best of my ability during the Q&A session. And again, as Hendrik mentioned, I think after the first 5 themes, we'll take a quick water break, and then we can answer any questions that have come up by that point. So the first theme, blockchain. So, I mean, like others, we do expect 2017 to be a major year for blockchain-related news flow in the banking sector. As you can see on the slide, financial institutions are forecasted to spend upwards of $400 million per year on blockchain development by 2019. And banks are really being drawn to blockchain for a variety of different reasons, including the potential to cut clearing and settlement costs, which have been estimated at about $80 million per year. But I mean, like so many other technologies where there's a clear efficiency angle, blockchain to us also raises concerns from a data privacy and security perspective. And indeed, recent months have seen a number of high-profile hacks at organizations that use Bitcoin, which is based on blockchain technology. So what we did for the report, our sector analysts covering the banking sector bundled some of the indicators from our ratings model to assess banks' preparedness to manage some of these data security risks. And the table shows the top performers on this composite metric. Now, we consider all of these banks to be generally well prepared to manage data security risks that we think could very well intensify as blockchain takes off. We ended up profiling Barclays in the report because in addition to having good risk management, it's actually particularly involved with blockchain applications and has a number of really interesting projects going on. And it recently completed the first trade transaction using blockchain technology back in September of last year. So clearly a trend that is having major disruptive effects across the auto sector is the growth of EVs, electric vehicles, as well as connected vehicles, where autonomous vehicles, or AVs, are really the end game. Now, it remains to be seen when the first fully autonomous and indeed fully safe vehicle will be produced, but it's clear to us that the race is on. And as you can see on the slide, annual connected car revenues, so these are revenues from connectivity features like collision prevention systems, vehicle-to-vehicle communication systems, and of course autonomous driving software are forecasted to hit about $150 billion in less than 6 years. So when we look at this shift, we obviously see a major growth opportunity, but we're also interested in the potential social and environmental benefits. You know, for instance, it's still early days, but studies do show that an increase in connected vehicles could lead to improvements in road safety, because over 90% of collisions right now are caused by human error. And the savings associated with the projected decline in collisions and fatalities have been estimated at over $1 trillion, but clearly estimates such as these are based on uncertainties and estimates about the future safety performance of AVs. And from an environmental perspective, early testing shows that autonomous vehicles could deliver up to a 30% boost in fuel efficiency due to things like optimized route selection and reduced idling. You know, so clearly there's also a number of benefits associated with this disruptive trend. But you know, on the other hand, it's precisely the path-breaking nature of AVs that we think is likely to draw increased attention from regulators. And a good example is the hacking risk of AVs. So this has been singled out as one of the important barriers to mass deployment of AVs, and I think the hacking risk will become, in particular, a growing priority for auto industry regulators. So this is really where ESG can add some insight, because we have indicators that look at the robustness of companies' quality management systems, which you could use as a proxy for companies' ability to mitigate non-traditional industry risks, such as those around cybersecurity. And as you can see here on the slide, these are auto companies that are involved in developing autonomous vehicles and connected vehicles, and it also shows their score on our QMS indicator. So we ended up profiling BMW as a way for investors to get good risk-adjusted exposures to AVs. So this piece is on cybersecurity, more specifically this chapter, and you know, our thesis on cybersecurity is clear. We think the growing importance of protecting data assets and the underlying systems presents a growth opportunity for companies that are offering cybersecurity management services. Global spending on cybersecurity is forecasted to hit $1 trillion that's on a cumulative basis by 2021. And as you can see here on the slide, the scope of data breaches appears to be increasing, which makes sense. I mean, if we think about how much more of our lives is being cataloged and stored online. So I think what's interesting about data security is that it's really quickly evolved from more of a niche risk to an economy-wide issue. It's no longer, and hasn't been indeed for quite some time, it's no longer telecom and software companies that are exposed. It's banking, insurance, healthcare, essentially any industry that manages or sits on large volumes of data. So we expect to see growing attention paid to cybersecurity measures by investors and boards in 2017. A BDO survey published in September showed that 3/4 of public company directors in the US say their boards are more involved with addressing cyber attack issues than they were a year ago. So as I said before, there's obviously a risk angle here, but for the paper, we also considered ways that investors could benefit from these trends. And we used our data privacy policy indicator, as you can see there in the table, to look for companies that are positioned to benefit as these concerns mount. And we profiled Symantec. You know, while the company does trail ATOS on the specific indicator we used, our analysts prefer it because it's a pure play after spinning off some of its non-cybersecurity related businesses and acquiring Blue Coat. And as you can see again in the table, it really does have excellent ESG capabilities overall. It's in the 96th percentile, excuse me, of all software companies that we cover. So our piece on solar, we decided to focus on the U.S. market because we expect to see a major expansion in utility scale solar in the U.S. in 2017. As you can see here on the graph, the U.S. is on track, in fact, to overtake Germany as the world's third largest solar market. And most of this growth, upwards of 70%, is coming from utility scale projects as opposed to smaller rooftop projects. So in terms of the drivers, I mean, clearly the market is sensitive to policy measures, in particular the solar investment tax credit. But we would say, generally speaking, the fundamental driver now is economics, not policy, as I think many on this call would agree. I mean, there's lots of data out there, but according to the latest Lazard cost of energy study, the unsubsidized cost of utility scale solar in the U.S. Currently ranges from about $46 to $61 a megawatt hour, which is down 11% since 2015. And this is due not only to declines in the price of panels, but also improvements in design and efficiency. So this really makes utility scale solar price competitive with fossil generation, although of course we recognize that the precise point of grid parity, it does vary state by state. Now, I have to say, I mean, obviously the solar picture in the U.S. is quite complex, and we didn't look at things like the political challenges around net metering and how this could dampen the rooftop market. Our thesis is simply that utility scale solar is an increasingly cost competitive and carbon-free method of generating energy, and utilities will continue to increase their solar capacity as a result. So in order to identify utilities that are betting on solar, we filtered our U.S. utilities universe using our energy mix indicator, as you can see on the table, and this is really a proxy for renewables and other low carbon forms of generation. So among the four that really stand out, we like PG&E as a way for investors to get exposure because the company has the top overall ESG score, over 150 megawatts of its own solar capacity, and it's also doing lots of other interesting projects around solar. So energy storage, this is an extremely topical discussion right now. Everyone is wondering if lithium-ion batteries will undergo the same sort of rapid price decline as solar PV panels have over the last couple of years. Lithium-ion battery prices have already declined from about $1,000 per kilowatt hour to just under $300 per kilowatt hour. This is since 2008. And as you can see in the chart, I mean, demand for lithium-ion batteries is expected to completely transform over the next 7 years. Now, of course, much of this demand is tied to the projected increase in electric vehicles, but we were also interested in large-scale lithium-ion battery projects as a way to help utilities and grid operators improve grid management and also address the intermittency challenge of wind and solar. And in recent months, there have been a number of projects in exactly this regard. I was reading about just a couple of days ago, a 20 megawatt Tesla project, a 30 megawatt project from AES. But something else to consider, I mean, we are bullish about the lithium-ion battery market for these reasons, but we also think investors need to be aware of some of these social and environmental impacts of battery production. we've written about this specifically with some of our other pieces. These would include the use of toxic chemicals in lithium extraction, and the fact that over 50% of global lithium supply right now is located in countries with relatively weak environmental regulations, such as Bolivia. But notwithstanding these concerns, our expectation is that the battery-based storage market will quickly expand in the years to come. So in our report, we really singled out Panasonic as a way for investors to get exposure to future growth in the energy storage market. The company's got about a 40% share of the global battery market, a really diverse product lineup, a partnership with Tesla, as I'm sure everyone is aware, and as you can see also, it's a generally strong overall ESG performer.
Okay, thank you, Doug, for the moment. As announced, we are now having a small Q&A break, also to give Doug the opportunity to drink a little bit of water. And fortunately, some questions have already been submitted to us. Obviously, the audience, Doug, is interested in the topic of cybersecurity and data privacy. So one question is about these two. Cybersecurity and data privacy were mentioned in several of the themes, Doug, you have presented. Can you comment on how investors are reacting to growing concerns over data management?
Sure, I can respond to that. I mean, as I said, definitely this is an issue of growing importance for investors, boards, and shareholders generally. I think it's interesting. I think I mentioned the study, the survey from BDO that showed in the U.S. certainly, company directors, board directors are increasingly seeing cybersecurity as a priority. And again, I think what's interesting also, as I said, is that it's just interesting to see how quickly this has become an economy-wide issue. It's definitely no longer telecom and software companies. It's, as I said, insurance, healthcare, banking. I think on the company side, it's not just about security. So, best practices would be checking vulnerabilities, implementing latest safeguards. It's also about the privacy. And some of the things that our analysts look at when we're evaluating this would be, having a commitment to notify data subjects in a timely manner following a breach. This is going to be increasingly important for companies that house personal information, and also seeking the consent of people for sharing non-essential personal information. So these are, I think, two areas where we're going to see a lot more traction and interest from investors in 2017.
Thanks, Doug. There's also a lot of interest in the autonomous vehicle topic. So first question from Rob. How do Ford and GM stack up in the AV development market from your point of view?
This, I'm afraid I will have to actually push that question to our sector analyst, who would have probably, I'd be happy to provide those details to Enrico Colombo, our lead auto sector analyst. He would have much more detailed information about where individual companies stack up. My purview on the thematic research team is a little more high level. I can quickly say, though, I think I was chatting with Enrico just before this call, actually, and I said, Enrico, when are we going to see autonomous vehicles? And most market participants think it will not be before 2020, but by 2021, 2022, we could very well have fully autonomous vehicles on the roads. I mean, clearly, there are insurance implications for insurance and regulation, etc., and these tend to trail the technology. So in the end, it'll likely be waiting for regulations to catch up. The technology, I think, is maybe already there.
Okay, thanks, Doug. And Rob, we will come back to your question then bilaterally. So a final question for this little break. So related to the blockchain topic, Doug. So what, actually it's a quite technical question, but what indicators went into the blockchain composite score that you have mentioned?
Yes, so the blockchain composite, this indicator, this composite was built by our banking sector analysts. It looks at, so the underlying indicators look at things like so data privacy and security programs, financial product responsibility, compliance programs, etc. So they bundled this together and use that as a proxy for preparedness to manage data security risks related to blockchain.
Okay, thanks, Doug. I think in light of time, we now have to continue with your presentation. So please move on.
Okay.
Next.
Thank you. Yes, so I will do that. So drug pricing. So this shifts gears a little bit in terms of getting away from some of the environmental driven stories. So essentially what's going on here is we think 2017 is going to be a difficult year for pharma companies that are planning to rely on significant drug price increases for revenue, especially in the U.S. As I think we all know, or many of us would know on the call, we've recently seen a number of cases where pharma companies engaging in aggressive drug pricing have faced blowback in the market. These would include Valiant and Mylan. And as you can see on the slide, high drug prices in the U.S., this is just one example, but it's using Gleevec. This is a cancer drug manufactured by Novartis. You can see here the differentials across markets with the price of this drug. So we do expect to see continued scrutiny over high drug prices in the U.S. in 2017, partly due to more and more evidence about the strain that they're putting on Medicare and Medicaid. So these two programs spend over $500 billion on prescription drugs in 2015, up from about $350 billion in 2012. And our pharma analysts also note that there's regulatory momentum on this front, which I think is really interesting. In June, Vermont became the first state in the U.S. that requires pharma companies to justify price hikes and improve company reporting. And of course, President Trump indicated on the campaign trail that he would advocate for lower drug prices. I mean, clearly though, whether and how this would happen is still unclear. But generally speaking, in this environment, with all these factors coming together, our thesis is that investors with exposure to the pharma industry can benefit by tilting towards companies that are using value-based pricing models, which set drug costs based in part on the response rate of patients. So basically, we think that these strategies can help insulate companies from some of the scrutiny, the growing scrutiny around high drug prices, but also rewarding effective treatments. And as you can see on the table there, several pharma companies in our universe perform well on our equitable pricing indicator, but our analysts, they prefer GSK because it has a relatively diversified revenue base, a good ESG score overall, and really extensive access to medicine programs. So we see them as being generally well prepared to compete in this environment. Diversity, yeah, this is, obviously this is a bit of a perennial ESG theme, but nevertheless, we do expect an upswing in investor attention to this issue in 2017. This is due to a few things. One is just the growing number of studies that have been published showing the benefits, the financial benefits of having gender diverse leadership teams. There was a launch last year of the world's first gender diversity ETF. And it did quite a good job in attracting assets over the course of the year. And I guess another factor is this is 2017 is the deadline, at least for French companies to comply with the gender quota in France. So I think, and there's some other factors too, but basically we do think this will become there will be an upswing in investor attention to this issue in 2017. Moreover, we also expect to see a broadened exploration of diversity to include things like ethnicity and even innovative definitions of diversity like thinking style. And we've already seen some evidence out there in the market that suggests more ethnically diverse companies can outperform less ethnically diverse companies holding for other factors. So as you can see here in the table, in order to provide a universe of companies that are positively exposed, we simply filtered on a few of our indicators that look at diversity, and we profiled Accenture. It actually is probably among the most gender diverse companies in our coverage universe, as you can see there in the slide. So tax, I would say this piece is a little different than the others. It's perhaps less of a of a clear upside theme. It's more of a recognition that public scrutiny over aggressive tax planning is mounting. And we really focus this piece on the EU because the European Commission has reviewed numerous and scrutinized numerous generous tax deals over the last 2 years, including the ruling against Apple back in August. And I don't want to get into too much detail, but essentially what's going on is the regulatory bar for tax reporting in the EU is rising. And there is a proposal out there from the EU for country-by-country tax reporting by large European companies that meet certain revenue thresholds. So our belief here is that simply that multinational companies are going to have difficulties benefiting from these types of advantageous tax arrangements going forward. And investors should respond by clearly understanding how prepared companies in their portfolio are to comply with tightening tax disclosure requirements. So the table you can see there on the slide, this shows a sample of the 84 European companies in our universe that score really well on one of our tax disclosure indicators. And we profiled BBVA. It's a Spanish bank because it caught our interest because it has been doing a few things like providing beyond compliance tax reporting since 2011. So our piece on the pay gap, this is similar to our piece on tax avoidance. It's perhaps less of a clear upside play, but really more of a response to regulation. Although I think what's interesting here is that since we published our report 2 weeks ago, already some uncertainty has emerged about how long the regulations we talk about will apply. Provisions, essentially what's going on is there are provisions in the Dodd-Frank Act from 2010 for companies to disclose their CEO to median worker pay ratio, and the final rule was implemented in 2015 by the SEC, and it will require U.S. issuers to start disclosing this ratio starting this year, depending on when their fiscal year begins. And again, I don't want to get into too much detail in the interest of time, but from what we've read in the last couple of days, there's new legislation that's likely to be introduced in Congress later this month that could very well repeal this pay ratio rule. But nevertheless, even if that happens, our take on it is that investors will continue to pressure companies for this information through their engagement processes. And one of the reasons is, first off, the notion of pay inequality is just so firmly embedded right now in the public's consciousness for a bunch of reasons. And secondly, there are a growing number of studies showing that high CEO pay can have detrimental effects on a company's short and medium-term performance. And one of the things we stress in our piece is that this is not just a U.S. issue. Calls for mandatory pay disclosure are picking up steam in other markets, including Canada, the UK, and Australia. So the basket of upside performers, if you will, is a little different with this particular story. This table simply shows U.S. companies that are already voluntarily disclosing their CEO to median pay ratio, and one of the reasons is partly because they have a quite a favorable ratio. And we ended up profiling Noble Energy because out of the four, it has a balanced performance across our corporate governance and ESG ratings model. And last but not least, the rise of plant-based proteins. So this is definitely a theme that we expect to quickly develop over 2017. Both the general health and wellness market, but in particular plant-based proteins. So this is stuff, food products like quinoa, lentils, soy, etc. I don't think the explosion in health and wellness that we've seen would be a surprise to anyone on this call. But just to demonstrate, as you can see in the graph, sales from the health and wellness market are forecasted to hit $1 trillion this year, which would mean almost a doubling since 2007, which is really quite remarkable. And the reasons we really focused in on plant-based proteins is because the purchasing drivers of consumers are changing. Consumers are increasingly motivated by health benefits and the types of ingredients used. And on the other hand, there's good evidence to show consumers are also increasingly aware of the broader social and environmental impacts of animal-based proteins. These would include things like water usage, the rise of antibiotic resistance, and just the generally high environmental impacts associated with meat production. And I think also what's interesting is this shift that we're seeing is normally associated with developed markets, but in fact demand for plant-based proteins is growing extremely fast across emerging markets as well. So I think it's much more broad-based than is sometimes believed. And China recently introduced dietary guidelines last month and the aim is to reduce China's meat consumption by 50% by 2030. So similar to our blockchain chapter, our food team analysts built a composite indicator specifically for this report, and it pulls together parts of our ratings model that look at product health initiatives, sales of organic foods, and other supply chain initiatives. So we would say investors can get exposure to health and wellness and plant-based proteins through all of these companies, but Danone is really the one that stands out for us. Not only does it have a really good overall ESG score, but it recently acquired White Wave Foods, which really favorably positions Danone in this market. So that concludes my brief summary of each investment theme. I hope I didn't fail in my goal of doing it succinctly. And I just wanted to quickly also point out this analysis, because starting last year, we decided we would go back every year and look at how our companies performed over the course of the year. So again, we started this last year. It was really well received by our clients in the market, so we want to keep it going. So this year, we look back at our 10 for 2016 companies. And as I said before, last year's report really focused in on climate change as a result of what was then the recent adoption of the Paris Agreement. So we selected a basket of 10 stocks. Basically, these were companies that we felt were favorably positioned to respond to tightening climate change regs and also upside product opportunities. And we decided, in addition to summarizing some of the ESG trends or developments that occurred at these companies over the year, we thought we would also test how a concentrated equity strategy would have performed against the market. So we built an equal weighted portfolio using these 10 companies. And as you can see, on a total return basis, it would have outperformed the ACWI by 5.6%. And if you look at attribution, I think what's interesting is there were two clear winners. Beauregard, this is a bioenergy company based in Norway, and Origin Energy from Australia. So these two companies really provided the bulk of the returns. But nevertheless, they were in the portfolio for a reason to begin with, and this was a climate change thesis. So yeah, I expect we'll repeat this analysis in 1 year's time, and we'll see how our 10 for 2017 profile companies played out. So yes, that's almost 40 minutes. So thank you all for your continued attention. I really appreciate it, and I'd be happy now to answer any questions that have popped up to the best of my ability.
Yeah, many thanks, Doug, for staying in time. It's quite a task with this long list of exciting ESG investment themes, and you stayed very focused. So thanks for that. And meanwhile, I received really a long list of questions. So let's see. Although we are quite comfortable with regard to time, if we get through all of them. So let's start without much further ado. Doug, could you once again explain how you went about selecting the themes and the companies?
Sure. So I cannot say we followed a scientific model to land on these 10 themes and companies. It was really a mixture of, as I said before, art and science. Effectively, we just looked around and said, look, let's try and identify 10 important ESG-related themes that are taking place right now in the market that, that are really being driven by some of the important background or macro level changes that we see developing in the market, including, obviously things like energy transition. The IEA is forecasting a plateau in global gasoline demand for the first time in its history. Lots of other exciting shifts taking place. So that was really our starting point. And then we supplemented that with some market forecast analysis to, to help pinpoint the themes. And then, as I said, at the end, we filtered a little bit and tried to get some diversity across E, S, and G. And then as far as the companies go, it was primarily driven by their performance on the indicators that we use to evaluate companies' exposure. But then we also hedged a little bit just to make sure we had some geographic diversity and diversity across markets.
Okay. Question number 2, diversity related. So why would a gender diverse company be expected to?
Oh,
that's a challenging one, Doug, isn't it?
Hendrik, I'm so sorry, I didn't fully hear you. Are you able to repeat that question, please?
Okay, sorry, of course. So why would a gender diverse company be expected to outperform?
Oh, yeah, there's been lots of research on this, lots of research done. I think I don't profess to be an expert on the literature, but from what I understand, there's some research suggesting that more diverse companies benefit from, they're less likely to fall victim to groupthink, for instance. It's simply a fact of having more diverse opinions in the company, in leadership positions, awareness of potential product ideas that, that may not be in the minds of everyone. So simply having a leadership team that reflects the market companies are serving, I think, offers a whole variety of tangible and intangible benefits.
Okay, and also related to the diversity topic, are you projecting a significant uptick in strategies around gender lens investing? What are your expectations there?
Yes, I do. I do project. I do expect that this issue will gain more traction with investors going forward. I think as more and more evidence comes out suggesting that there is excess return that can be captured by investing in companies that have relatively highly diversified management teams and boards. I think this will help motivate both product development and investor interest in general.
Okay, maybe another question that fits to this a little bit at least, the pay gap ratio. How can the pay gap ratio be compared across industries and countries?
Like a gender pay gap ratio, or
no, nothing to do with, but your pay gap theme. So and pay gap ratios that have been mentioned.
Right. I think
so. In the comparability question around it, yeah.
Right. I think it's very challenging. I mean, I would definitely want to get the opinion of our corporate governance specialist on this, but I think generally speaking, their norms vary quite substantially by region and country. So I think a typical CEO to frontline worker ratio in the U.S. could be 250 to 1, but that would be extremely high for many European countries. So I think it's very difficult to compare this ratio across markets.
Okay, maybe going to the next gap, and this time the tax gap. So a question from the audience is, why not measure the tax gap directly instead of tax disclosure?
The tax gap, that's a good question. I think I don't think we have indicators off the shelf that can be used to measure the tax gap. So we used the disclosure indicator as a proxy. I think if we did more deep dive analysis on this topic, we would definitely want to get under the hood and measure that information more directly.
So, and if I may add to this, obviously this also raises a comparability question, even much more so than in the pay gap case, from my point of view. So, lots of things to do going forward. So, next question, looking at the plant-based proteins market. Can you comment again on the drivers of this market?
Absolutely. I think the drivers for plant-based proteins are in many ways the same drivers that are propelling the health and wellness market. So there's lots of evidence coming out about how the drivers of consumers' buying decisions are changing. Consumers are increasingly, as I said, being motivated by health benefits, and especially among millennials, there's also much more awareness about the broader social and environmental impacts that go into product development, supply chain impacts, etc. So I think this is really propelling this market. And what's interesting is that it wasn't that long ago that health and wellness was, I don't want to say a niche industry, but certainly not necessarily on the radar of the large food companies. And now it's like the #1 strategic battleground for many of the world's biggest food conglomerates in 2017. So it's clearly a massive opportunity. And then one other point, I guess, would also be I think there's also broad-based awareness about some of these negative social and environmental impacts associated with meat production. We've all heard the stats about how much water is required to produce 1 pound of meat, for instance. So I think this is also helping to shift demand towards meat-based or plant-based alternatives.
Okay, thanks for that. See what's coming in. Yeah, a question to the solar power market. So could you please again summarize the driving forces for the growth of cost competitiveness in the solar power market?
Sure. The primary driver is panel prices. It's these constitute the bulk of the total levelized cost of solar power, and this has been widely reported. The cost of solar arrays and panels has plummeted in a way that I don't think anyone really expected. Of course, this is not great news for panel developers. And last time I checked the market, they were forecasting a pretty significant supply glut in 2017. So I don't think it's necessarily great news for panel manufacturers. But for those of us who are buying and using the panels, it definitely is good news. So yeah, this is the primary driver, and I think we focus that particular story in the U.S. market, and of course there are some policy incentives that also need to be taken into account. But generally speaking, we see this market being driven primarily by economics now, not policy.
Mm-hmm. So we really receive a very diverse set of questions. So this one more technically oriented. So Doug, it's really challenging for you, this broad spectrum. So do you use any ISO norms in your metrics? So probably looking at the metrics you have applied to identify companies in the respective issue contexts, are any ISO norms entering the equation with any of these topics?
So we're talking about International Standards Organization norms and metrics here?
Yes.
Yeah, I don't believe so. I'd have to get back. Again, my purview at the company is on the thematic team, so I'm a little bit more high level. I don't always have day-to-day an understanding of how what goes into the ratings models, but I don't believe we rely too significantly on ISO norms.
So we can promise to come back to this question and explore what is behind that, so you can expect to get an answer on that question delivered to you after the meeting somehow. So yes, and then another question to the energy market. So how do you compare solar to wind?
Solar and wind, I think each has advantages. Generally speaking, it's the trends we talked about in terms of falling renewables costs apply to wind as well. The levelized cost of wind energy has also come down substantially over the last 5 years. But according to our information, certainly in the U.S. market, which is where we focused our piece, solar is slightly more cost competitive than wind. And I think the other interesting thing about wind is, again, I'm not an engineer, but I think the big trend that we're seeing right now with wind is offshore installations, because they have much greater efficiency because of wind speeds and things like that. So I think going forward we're going to find a lot more offshore wind projects in 2017.
Mm-hmm. And then maybe we come to the last question for today. So do you intend to follow the development of the themes over the course of the year?
Yeah, I think we will. I don't know how systematically we'll do it in terms of we may or may not do a formal check-in, but I think certainly anecdotally we're going to follow these trends and see how they play out. And of course, when we do our report next year, it will certainly be very interesting to look back and see how the companies we profiled performed in the markets.
Okay, great. So we are 5 minutes to the top of the hour. So I think What remains is that I would like to thank the audience for participating. I would also like to thank Doug again for this really challenging task to present 10 themes and answer all this diverse set of questions around a diverse set of themes in such a concise manner. So thanks to you. Yeah, and certainly we are hoping to see you again in one of our next webinars. So thanks again to the audience, and see you soon next. Thank you.